Hello and welcome to Hedgeye NexGen, where we're going to break down finance into its simplest form and help you build wealth. As always, I'm Ryan Ricci and joined by Ish.
Happy to be here as always.
We have a really fun one today. So basically, I didn't know what to present, so I went to the GBT of the chats
Yep.
and I said, "What are the most controversial topics
All right.
in finance?" We actually hit a lot of them unknowingly, but what ChatGPT said was very controversial right now is buying a home still the American dream or a trap?
Definitely a topic of debate. Some people say your home is your most valuable asset. Some people say it's not an asset at all.
Really? They
Yeah.
say it's not even an asset?
Some people say that because it's depreciating and you wear and tear on the house.
How is it depreciating?
Well, because you're living in it. I mean, I don't know. It's just
Okay.
some
All
arguments.
right. Well, all right. We'll tackle that for sure. And so we did a little bit about housing with Ariana when she was on. But I tailored this a little bit more to tackle these two different arguments. And so one side of this argument, by the way, this can be a very good episode. I got a lot of data. One side of this argument is home ownership is the ultimate wealth builder, right? And then the second side is renting and investing is smarter in today's market.
Okay.
Okay. And so I think my view is kind of somewhere in the middle. And I think it's more that there's a time and place for everything. And that you can't raise kids in a home or in a stock portfolio. You can't raise kids in a stock portfolio. And so I think that's where the time it's all going to depend on your point in life.
You're kind of arguing like you got to own something.
Yeah. Well, like if you're it's a lot easier to have 3 kids in a home with a yard than in a small apartment.
Yeah, where you're trying to like save money, invest more in stocks or something like that.
Right, exactly. Right. Like your kids are going to need space.
Yeah.
And how do you get space? It's probably going to be a home.
Yeah.
Right. And so, but there is the flip side where we'll go through all the numbers for everybody where the renting and investing does make mathematical sense. And so we'll go through all the numbers for everybody. But I think really why this debate is coming up is 2 reasons, twofold. One is it's the home prices versus stock market returns. Okay. And the second big one is houses are more unaffordable than ever. So why are people talking about renting more? Because nobody can afford a house.
Yeah.
So that's why people are talking about more and why this is even a debate. It's because people can't afford it. So I think really ultimately what's kind of going on is people are trying to get comfortable with the fact that they can't afford a home.
They're trying to justify it and say like this is the better way, it's the only way right now.
Exactly.
And maybe it is. So we'll get into it.
Right. So we'll get into why they're feeling this way and what's going on.
Yeah.
And we'll get into all of it. And so let's just first we're going to tackle the whole affordability question of what's going on in home prices.
Okay.
So we do have slides. They're very simple, but we'll talk to the first one. So just simply what it is, it's home prices versus the S&P 500 since 2000. Okay. So the return on a home price since 2000 is 224%. So your home would more than doubled.
It does appreciate.
Right. So it does appreciate. It is not a depreciating asset. So whoever told you that was wrong.
Wrong argument.
Wrong argument. Don't go there. Versus the S&P 500 in the same time is up 550%. So you're going to notice that the stock market had double the returns of a home.
A little bit of an opportunity cost there. 300%.
Exactly. And so when you start to look at essentially, so what's the rate of return? Rate of return on the S&P 500 is about 10% a year. Rate of return on a home is about 5% a year.
Okay.
So what's happening is the rate of return for the S&P 500 is double than it is for a home. Okay, so that's where the first part of this math problem comes into play is essentially, you're not wrong that if you have your money in a stock portfolio instead of a home, it's going to be larger.
Right. That said, though, they're different things. Like you said, can't raise kids in a stock portfolio.
Exactly. So they're just different things. So one side is 100% right,
Mhm.
and that's where this is begins to come from, because they're going to do the math that we'll do at the very end, which is essentially, if I put my money in one versus the other, which one's going to have the most, and
Right.
it's going to be the stock portfolio because it grows more. But the second part is the whole question of houses are not affordable for people right now.
Yep.
And so if we go to the second slide, where is that all coming from? It's the mortgage rate. So the 30-year fixed rate mortgage right now is at about 6.81%. Okay, that is about as high as it was back in 2008.
That's quite a jump right there.
Massive jump. And what it was in 2020 was 2.6%. So the jump from 2.6%, which was an all-time low in mortgages, to 6.8% is massive.
It looks like in 2023 in October it hit a 20-year high almost.
Yeah, it did.
Something like that.
It did. It hit the highest since 2000.
Yeah.
Is what happened.
So we're at an elevated level right now.
Right, but what happened? But like the biggest thing to know is we're only 5 years away from the all-time low. So
That's true.
So what happened during 2000? Everybody bought a home. Everybody was buying a home because it was cheap. This is basically
that was cheap to them.
Exactly. It was very cheap to them.
Yeah.
It was very affordable because
look before that.
Exactly. Well, mortgage rates are essentially your monthly payment on your house.
Yeah.
So if this chart is going down and it's at an all-time low, that means the monthly mortgage payment is pretty much at an all-time low.
Mm-hmm.
Okay. So when something's at an all-time low, people bought houses like they just bought everything. That's why there is no inventory right now, because they all bought a 30-year fixed rate mortgage at between 2.6 and like 3.3%.
Wow.
Okay.
That was in the past few years.
And that was 5 years ago.
Yeah.
So they've been in that house now for 5 years.
Okay.
At this unbelievably low rate. Now the rates are 6.8%, which is about double.
Yeah.
So that means that's where the mortgage rate gone. So basically, how do you get housing affordability back down? You have to get your mortgages back down.
Right.
Is what will ultimately show.
How do we do that?
Well, we'll get there in a couple slides, but also I think it's important to note is the other time was 1980 was when mortgage rates were actually at 18%. So if you have a grandfather talking about, well, when I was a lad, my mortgage was 18%. It literally was about 18%. And it's been coming down all the way to the low in 2020 of 2.6%.
So this makes me wonder, did you say in 2000 everyone was taking out a mortgage for a home because it was low?
No, in 2020. 2020 they were at 2.6%.
Okay.
It was
all-time low.
The all-time low. Essentially, that was the pandemic, and it created a massive boom.
I should have,
Well, when you can loan, you get a loan for 2.6%.
Yeah. Why not?
People are like, why not? I'll get a loan at that rate.
Do it.
Right. Which makes sense. But now that rates are a lot higher, it doesn't make as much sense.
So they took all the housing off the market.
They took a lot of it off.
I see.
Yeah. There wasn't a lot to begin with. But what happened was you have all these people that could afford a home now buying homes, and now they're not moving.
Yeah.
Because they don't want to move, because they moved. Now they have to pay a 6% mortgage.
Yeah.
So why would you go from a 3% mortgage to a 6% mortgage? You wouldn't.
Makes no sense. It's only been a few years too.
It's only been 5 years.
Maybe in some amount of time you'll see more people moving just as a natural trend. But
exactly. So now let's go to housing affordability. So as you would have guessed, housing affordability is at an all-time low. This chart goes back to 1986. And so you can kind of see it basically is an index showing how affordable are houses. And you can see basically in 2006, they were pretty affordable. In 1986, they were pretty affordable. And then 2021, they were, I got that completely wrong. In 1986, they were not affordable. 2006, they were not affordable. And right now we're at an all-time low in affordability. and they were very affordable in 2021 and 2012 was the peak.
Yeah. So I don't know if you know exactly what this is based on, but why is it? It's interesting that today's levels of affordability are the same as in 1986, even though the mortgage rate was 18% back then, but today it's 6.8%. Why is the housing affordability index at the same level?
The income.
There's other
It's the
factors.
percentage of your income going towards total debt,
Yeah.
and basically their income was justifying it.
Back
essentially. Yes.
Okay.
Yes. Like they were better off in terms of all the expenses that came in, right? What is left over? They were better off than right now.
So what is it now? Income levels are down or prices are up?
Prices are up, income levels are flat.
I see. Okay.
And so
Makes sense.
it's just extremely unaffordable.
Even at 6.8% mortgage rate as opposed to 18,
Exactly.
just as unaffordable.
Exactly.
Yeah.
Exactly. So that's why you can't just look at the mortgage rate. It's much more
Yeah,
holistic
a lot of things
picture. And I would say that's in 1986. And in 1986, on the other chart, the mortgage rate was 11%. So
Okay.
it wasn't quite the 18%. It was 11%.
Yeah.
Okay. So still, though, we're at all-time low affordability, as one might guess from what's going on.
Yeah.
Now let's go to the second one, which really goes into this gap. Okay. So this is looking at the gap of the actual median income, which is the blue line, which is currently at about $80,000 versus a qualified income, which means the amount of income you need to be a qualified buyer for a home.
Oh, geez.
Which is the orange line. Okay.
That's a gap, all right.
Yeah. So the qualified income right now to buy the median home price. So the median home price is about $390,000. The qualified income for that would be $121,000 a year. Okay. The actual income people are getting is $80,000 a year. So in order for you to be a qualified person, you need a 50% raise from where you are today to buy the average home.
That's not happening for a lot of people.
Right.
Not yet.
Exactly.
That's a crazy gap. That gap between the two lines today is as big as the entire range of the blue line over the past 12 years.
Yeah.
So
exactly. So
where did that come from? What happened? It's because income levels are flat, like you said.
It's income levels flat, prices going up.
Yeah.
And I think there's a broader sense too of so how does inflation get out of control?
Currency debasement.
Your governments are printing beyond wazoo. They're taking out a boatload of debt, and money's just being pumped into the market. Asset prices are getting inflated crazy high. And all of a sudden you have this growing gap between the rich and the poor. The rich have all the assets. The poor people have no assets. So all their assets are, while the government's spending, their assets are ballooning. So now they're able to afford a boatload, but the average person can't afford anything.
Yeah, I definitely think that's the underlying behind all these increasing gaps on every chart we pull up.
Yep.
And that's kind of, I think, as we'll get into it, the argument of renting is the better choice than buying. That's only going to increase that divergence over time, because then if you're the bottom people choose to rent, they're not even trying to buy anymore. They're just going to keep sending money up to the actual asset owners of the homes.
So yes, as long as those people renting aren't also buying stocks with their savings. If you're just renting and you're not investing, what you're saying is 100% true.
Then you're going nowhere.
And you are, the gap between the rich and poor continues. But if you're a renter and you're taking the difference between owning a home and renting, and you're investing the difference, kind of like we did with the whole life term life thing, then you actually do have assets in the S&P 500 or Qs or whatever it is.
More than the house.
And it's going to appreciate more than the house.
Yeah.
So it depends what you're doing with your leftover money.
Okay.
So, but yes, if you're just renting and you're not investing and you're owning zero assets, which is most of Americans.
You're just on a treadmill.
Yeah, you're on a treadmill.
Forever.
And it's only going to get worse because people that own assets, their money's appreciating.
Yeah.
Yeah. So that's the big one, is that gap. And then we get into, okay, so what's also happening? And it's basically on the next slide, it's US mortgages above and below the national average. So how many mortgages that people currently have are above where the mortgage rate currently is or below?
Okay.
And essentially the idea is if your mortgage rate is above the current mortgage rate, if you sold your house, you can get a lower mortgage, aka a lower monthly payment. Okay. But if it's below, what happens is if you sell your house, then you're going to have to take on a higher monthly payment for a mortgage.
So you're less likely to sell your house.
You're less likely to sell your house. And so then you look at, okay, so how many people, hopefully there's a pretty equal set where the amount of mortgages above and below is about 50-50.
Something that's balanced, and that way there would be like a available home market.
Right. People are buying and selling freely. If you have a change in your life, you're selling and buying.
You're not like super disincentivized to sell.
Exactly. You're at equilibrium. You're not disincentivized or non-incentivized, right? You do whatever you want. That's not the case. 98% of mortgages are lower than the national average mortgage rate.
That is a crazy chart.
98%-ish.
And so that's all the people that just got it in the past few years.
In 2020.
At all-time lows.
At all-time lows. So 98% of the people out there have a mortgage that is at
2 or 3 points below.
Well, and
or
then
1, 2, or 3. But
82% of them are more than 2 percentage points. So if it's 6%, they're at a 4% mortgage. 82% of people are 2 points below the national average.
So it's like you could be guaranteed the majority of that 80%, they're not budging.
They will not budge until mortgage rates are about 4%.
Yeah.
Until you see mortgage rates at 4%, they're not budging. And they're going to stay in that home.
People are they're hodling their houses.
They are literally they're hot. It's Eric Genron, our producer. He's very happy to say he bought the house at the lows and 2.99 mortgage.
Well done.
Way to go, Eric. And he's never going to sell it.
Why would he?
I don't know.
Until the rates come down.
Until the rates come down, then maybe he would sell it and maybe unlock some value. Because what happens if when you sell it, you can unlock some value of the home. There's a whole bunch of things that happen. But until mortgage rates hit 4%, you're not selling the home. No. And so everybody's like, oh, inventory is so low, all this, whatever. It's going to be this low until mortgage rates come down to about 4%.
It's not changing.
It's not going to change.
Now, what?
So let's go to the next chart and the last chart, which is let's put up where is the 30-year fixed rate mortgage currently? It's at 6.8%. So how do we fix this to get it down to about 4%?
That's what I was going to ask. I don't know. Does building more homes do anything?
Yeah. So how do you fix it? Is you get the 30-year fixed rate mortgage down. How would you get the 30-year fixed rate mortgage down? It's very equivalent to the long-term yield of the 30-year yield. How do you get that down? You have lower inflation and you have lower growth. It's basically a quad 4 environment of what we call it, which is essentially a recessionary type of environment, is the only way to get these mortgage rates down. But you know what's going to keep these mortgage rates sticky high and or going higher? Inflation, which means if you're hearing your government spending money or increasing the debt ceiling, which they just did,
or lowering interest rates,
well, they can't lower interest rates when they're doing all this because inflation's going up.
I guess that's true. Yeah, they're not.
Right. So in order for things to get more affordable, right, you can't be raising your debt ceiling, right? You have to be lowering your budget. The government has to start tackling that debt, essentially.
Yeah.
And that will start to lower our growth because we're not spending the money elsewhere. We're paying off our debt. Okay. And basically lower that. Stop devaluing the dollar. Stop devaluing your currency. Stop printing your currency at astronomical rates.
Mm-hmm.
This is how you would get more affordability in the housing market.
So rates will come down when future expectations of expansionary economics start to come down a little bit,
Exactly.
that's what brings rates.
Exactly. And that was happening like a couple months ago.
The whole tariff thing.
Right. The whole tariff thing. Why is the tariff thing happening? Because people are expecting growth to come down a lot.
Yeah.
What also was happening, the Doge people were actually doing a massive amount of firing. Thing is, they only did that for about a week, and now they stopped firing, and it's like, okay, we're not actually going to cut the budget, right? It's like they were talking about budget cuts. They were talking about cuts of everything, right?
Mm-hmm.
Right. So that is why it started to come down a little bit, but it came down from 7.79 to about 6.5.
God, so you're gonna need a lot more of that.
Exactly.
Bring rates down to 4, 3.
Exactly. It brought it down like 1 point. Right. You need so much more. But the second that they stopped doing that, what happened to mortgage rates? They've gone right back up to 6.81. So they went from about 6.5 to 6.81 once they all stopped doing this.
Yeah.
So that's
too much.
That's
too much growth.
It's too much inflation.
Growth, expansionary economics.
Right, exactly.
Money printing.
Right. So
no end in sight.
It's yeah.
I wonder what Powell will say next. Maybe he'll.
But it's like, well, there's nothing like he can really do about it either, right? Because like, let's say he starts cutting rates, he's cutting the short end of the curve. The long end is the 30-year yield. If he starts cutting there, it's going to actually increase inflation. Inflation starts to go up. What he could do, though, is if he raised the short end, that could start to slow growth and actually slow inflation. And that could actually bring back down the long end, right?
But you think at the end of the day, it's really primarily up to the government spending, budget deficit, ceiling.
You just have to get the 30-year yield down.
Yeah.
And you have to do whatever gets the 30-year yield down. And we just saw what was starting to get it to go down, right? All the narratives they were talking about and so forth, right? The second they flipped all their narratives to like, we're going to have tax cuts, we're not going to keep firing and all that, you flip that script and all of a sudden the mortgage rate goes right back up because the market like knows like you're not serious on cutting the cost for people.
Right.
So,
okay.
So yeah, that's basically what's going on. Or you have people, the other side of this, people get big raises. They get 50% raises.
Okay. And then
they can afford it.
Yeah.
They can afford the house.
50% raises.
So you need a 50% raise, or the other thing that we're talking about happens.
Find a place that'll hire you and give you a 50% raise, I guess. That's good.
I guess so.
That's the objective.
Right. But for most people, that's not it's not going to happen. It's not going to happen. Or they take on a third job, right? Or a second job. And it's like, okay.
More income, I guess.
Right. But you're working a lot more. So, so yeah. So
these are all the reasons people don't want to buy a home today.
Right. So why is this narrative getting a lot higher and this debate even happening? The debate's happening because people just can't afford a home. So they're trying to say, okay, I can't afford a home. Is renting so bad? And so that's why you're hearing this narrative more and more in today's talk, because people can't afford them.
Yeah. Yeah. I mean, I guess it depends what your rent is going to be.
Yeah.
Where you're living, what the market is there.
Yeah.
Prices.
So we'll do that. We shall now go into the numbers. So we'll go into the numbers. The next big narrative is when you're renting, you are throwing away you're basically right. You're throwing away money, right? And mortgage is ownership. Okay. Mm-hmm. So let's go to an example of this exact topic. So the average home in Stanford, which is where we work, so we'll use that as the average, is $667,000. Okay.
Okay.
So if you're going to put 20% down, you're going to put down $133,000. So you need $133,000 in cash.
Right. Up front.
Up front. And then you're going to get a loan for the other 80% of that. So $534,000.
Okay.
Okay. Now your loan is going to be at a mortgage rate of 6.71%.
Right.
Okay. And what that does is that puts your monthly payment for the mortgage alone at $3,450 a month.
Okay.
That's your mortgage payment. Okay.
And you're gradually increasing your ownership as you pay.
Yes.
Yeah.
Yes, you are. But with a home, it's not like rent where you just pay your rent. No, there's more things. You have to pay your tax. You have to pay taxes. You have higher heating costs because the home's probably going to be bigger than an apartment.
Yep.
You're going to have Wi-Fi bills. You're going to have security charges. You're going to have to pay for garbage. You're going to have to hire insurance.
Yeah.
You're also going to have a yearly bill because they have to service your oil tank.
Yep.
Essentially, you're going to have a lot more yearly expenses with owning a home because it's more work.
So it probably adds up to maybe 4 or 5K a month if you incorporate everything.
Yep. So when you add in all those additional expenses, you're going to add in $1,380 a month, which brings your total monthly payment to $4,831, most likely for this home.
All right.
Okay. So, yeah, which is what they don't tell you. And if the average renting cost in Stamford is, we're going to say it's $2,000 for rent, and you're going to still pay for insurance, Wi-Fi, and utility, but it's much less, bringing your total cost for renting to $2,235 a month.
Okay.
So it's a difference between paying $4,830 for a house and $2,230 for an apartment.
Right.
Which is about basically the house is double a month. Okay. So now let's create a stock portfolio, right? Because if you're just do the cost benefit analysis, should I buy a home or should I have a stock portfolio? Your down payment is going to be $133,000. So that would be your beginning balance for the stock portfolio. And then you're going to every single month
take the difference
between the two, which is about $2,000.
Yep.
And you're going to invest that into the stock portfolio because it's $2,000 because you're subtracting out your rent.
So it's all the money you save by renting as opposed to buying a house, taking all that money and putting into the stock market.
Exactly. It's about $2,500 a month.
Okay.
And then you're going to invest it. And then what's going to happen is your stock portfolio is going to grow at 10% and your home is going to grow at 5%. And then what we can do is we can calculate the difference between your value in the home versus your value of your stock portfolio.
Right.
Okay.
And how long is the home mortgage? 30
years.
Okay.
We're going to do a 30-year investment time horizon.
All right.
And you can probably already guess what's going to happen because we know the value of compounding.
Yeah.
When you're compounding at something that's 10% versus 5%, it's basically
huge.
It's going to be a huge difference.
Absolutely huge.
Yeah. And so we already know who the winner is going to be. It's going to be the stock portfolio. Okay. But we'll do it. So, let's see, just making sure I'm following these notes here. At the end of year one, the stock portfolio is going to have 33,000. Your stock portfolio is going to be larger by $33,600.
Okay.
Okay.
What's the ending value? Because you put in 130K at first, right?
So at the end of 30 years, your stock portfolio is going to be $5.5 million.
Okay.
Larger. $5.5 million larger.
Well, what was the 30K you said? What was that?
That was at the end of 1 year.
Oh, 1 year.
At the end of 1 year, it'd be $33,000
Oh, that's
larger.
crazy. Already in 1 year? Okay,
yeah.
Jeez. But it's unrealized, I guess.
And $5.5 million at the end of 30 years. Why? Your stock portfolio is going to be $8.4 million and your home is going to appreciate to a value of $3 million.
Yeah.
It shouldn't be because you're compounding one at double the rate, right? And so 10% is way bigger than 5%. And so the value, it's just...
Yeah. And theoretically, so we've assumed 5% per year on the home, but 10% for the stock market. Yeah. Theoretically, these could change. But I guess in general, like in an environment where they're both going up, the stock market is always going to go up more than the housing.
Yeah.
Probably.
Yep. And the house is going to go down less than the stock market, yes. But on the up periods, the stock market's based on history, the stock market goes up
Yeah,
more.
it might be more volatile, but you give it 30 years,
Yeah,
compounding, it's gonna, overrule any of that.
exactly. And so the math is the math on that, right?
Yeah.
Like that's why that's why I really do think there is some rightness to the whole argument
I mean,
that renting is not really throwing away your money. Like
if you don't throw away what you're saving,
exactly, and
that's the
that's a
very
big
specific point there.
it's a very big if. If you're just like it's really the whole point. Like if you're sitting there and you're just going to the club every weekend, you're
Going out to
not
eat,
you're going out to eat
on
every
vacations,
day.
traveling the world.
Yeah, vacations, traveling the world, getting credit card debt, all this stuff. If you're doing all that while you're renting, then yeah, you're throwing away your money.
And you're not going to get that 5 million difference.
Yeah, you're not going to get the 5 million difference at all. You'll have basically $0 at the end of it versus the other person has $3 million, which is their house.
Yeah, true.
Right now, if you're treating your renting period part of your life as I am going to fix my finances, I'm going to basically clear all my debt, I'm going to like invest, right? Like save up for the home, stuff like that. Just clear debt, get your finances to a spot where like you own your stuff, right? Like you're not living paycheck to paycheck and so forth. And then you have the ability to start investing all that your money as well, and you're utilizing your renting period like that. Okay, renting is not throwing away your money.
No.
You're taking advantage of living at a lower cost for a small a period of time. Because when you're a solo male, female out there, you can have as much fun as you want, right? And like, it's fun.
No responsibilities.
No responsibilities, like there's
invest all your money or whatever you
right.
want to do.
No reason to take on the large expenses and so forth. Like it's totally makes sense. Totally makes sense.
Yeah, absolutely. So is there a counter to this then? Because the math shows renting's pretty good in today's environment, at least.
Yes, it is. It is. Let's talk about interest rates. So that example is at an interest rate of 6.71%. Now, when you're doing that, because it's a mortgage, right? And mortgage is a loan. And so it's debt, which means we pay the people we don't like on this show, which is the bank.
The banks.
Right. So over your 30 years, $708,000 is how much you're going to pay to the bank. $708,000 on
in those monthly payments.
In the monthly. So on a loan of $534,000. Over 30 years, you're going to pay the bank a total of $708,000. Okay. Now, let's say we lower the interest rate and the mortgage rate to 3.27, which is what it was about during 2020, where all these people have their mortgages.
I'm going to guess that 708 gets cut in more than half. Am I right?
I think, yeah, you are right. Their total interest payments go to $304,000. So you're paying $403,000 less to the bank over your 30 years. It's a massive, massive difference. And then what also starts to happen because of this is, we'll get to the final, is your monthly payment goes down, right? So your monthly payment went from what was, let's see, where is it? $3,400 to now on the mortgage to $2,300. It was $1,100 less every single month.
Imagine investing that in the market then. That's the strategy then.
Well, kind of. The math still doesn't work because what is important there is you're paying way less to the bank when the mortgage rate is low.
Yeah, absolutely.
And it becomes way more affordable for the average person. And when you start looking at the difference between a stock portfolio and the housing market, that goes down more. So right, the math before on a 6% mortgage, 6.7% mortgage, at the end of 30 years, the stock portfolio would have been, it was $5.5 million more than the house. When you cut the rate to 3.27, the the stock portfolio was only
Okay.
$3 million larger. So it went down by 2.5 million.
So
The difference between the two becomes a lot less, and it starts to make people want to more own a home because the math is more in your favor.
less incentivized to rent in that case. Like you're not gonna save that much more money.
Exactly. You're gonna be less incentivized.
And there's the whole argument, which isn't factored into any of these numbers, is like you said at the beginning, you can't raise kids in a stock portfolio.
Yes.
That's like a kind of intangible part of it, which is space.
Yeah.
Like you have family, other
Yes.
stuff. I don't know.
Yeah. I mean, I grew up with 3 other brothers, and I could not imagine being in an apartment. Like,
Be tight.
it would be. I mean, we were already like crazy breaking things.
Yeah.
I mean, put us in even a smaller space. Oh my gosh.
Right.
Right. But that's why people ultimately, like, they all want to buy a home. Right. So the question is buying a home still the American dream?
Right.
Yeah, it 100% is. People want to be able to buy a home, but they currently can't buy a home. It's not affordable for people to buy a home. And it's just the gap between the rich and the poor almost. And it's like, because all these people, like, when you're gonna get older, you're gonna raise a family. You're gonna have to figure out, how do I afford this, right? And hopefully you're building a little portfolio, chipping away, and so forth. So
So I guess like maybe the conclusion is, right now where we stand today, renting might be a more favorable option right now. But that said, if mortgage rates come down, then you could switch. You could rent now and then get the home when the rates come down.
Yeah. Yes.
If they come down.
If they come down, but I think also that narrative will also switch too when the mortgage rates start to come down as well. The whole narrative between, like, is home buying dead? Well, it's going to start to shift because now more people can afford to buy the home,
and they want to buy a home,
and they want to buy a home.
Yeah.
Right. Like. So I think that's the big thing.
And none of it factors in the intangible space aspect of it.
Yeah, which I think is actually like pretty big.
Definitely, it's big depending on the person. It's a subjective thing.
Yeah. Well, your priorities just change, right? Like, basically, when you start to have a family, like, your priority isn't how big is my stock portfolio, is like, are my kids getting an education, right? Like, your priority shifts away from money almost to like. It's just a
family.
It's to a family.
Yeah.
It's just a totally different question.
Very different.
Yeah, when you're young, it's portfolio, is
money.
Yeah, exactly. And then I think this might be my favorite part of the show. Let's talk about things that suck about buying homes.
Okay, there we go. Yeah, another intangible aspect.
Yeah,
of it.
Closing costs are nuts. Like, in order to close, right?
Just like a fee to the.
You have to pay lawyers. You have to pay home insurance up front. There's property taxes up front. Dude, I had to pay 9 months of property taxes up front.
Why? Is security for that?
It was security for the bank, essentially.
Yeah.
So that was fun.
It's a lot at once.
And then you have to pay the lawyers and so forth. And so, like, it was.
Yeah, add that.
So, like, and not only do you need a down payment, you also are going to need another like $20,000 to $30,000 just to close.
Mm-hmm. Basically, part of the down payment, upfront costs.
Yeah, exactly. It's a lot higher than people think with all those closing costs, which is awful.
Okay.
Maintenance.
Yeah, that's a big one, right?
Yeah.
You never know what you're going to get with a place.
Yeah.
You have some idea. You could check it out first. You better do a good job. But,
Well, I'll be a prime example. I got bit by a spider.
Spider bites.
Well, so what I'm doing, everybody, by the way, so I did buy a house. I went on to this.
So you have some experience to be talking about this topic for sure.
Yeah. Well, the funny thing is, do all the math, right, for my wife, right? I'm like, okay, here's the math here's the difference of how much we could make and so forth. And literally, she could care less basically about the math.
Like, buy the house.
We're buying the house because we're going to get married. We're going to have a family, right? Like, I could care less about what your math is telling me right now.
So that's for you to convince yourself it's okay.
I'm like,
but we're getting it.
I'm like, okay, Okay, as long as you realize the math, but sure, we'll go buy the house. But it's gonna happen to everybody. But yeah, so like the maintenance of houses is absolutely nuts.
What kind of maintenance we're talking about?
So I'm moving a rock wall right now. So I have so many problems. So basically our backyard there was a forest in our backyard. Okay. Then they decided to cut down the forest. They told us because to make more flat land, I think they were lying to us. I think it was really they had to get to the septic tank, and a big excavator has to get to the septic tank because they had a crack in their septic tank that we found out.
I see.
And so they had to cut down the forest in order to get to the septic tank. But everybody lies to you when you're buying a home. And they said, no, you want a flat yard? Here's your flat yard.
Got the flat yard, I guess.
Yeah, thanks.
Did you want the forest?
No, I would actually like the flat yard, but the problem is I don't have a flat yard yet. I have a pile of wood chips that's basically like 4 feet high. And so I don't have a yard. I have wood chips, so no grass on that. So basically, I've been calling pool companies. I have called over 20 pool companies to say, hey, when you dig your next pool, come and give me your dirt because I need to raise the level and to make my yard flat. And so in order to do that, because we have we also have another problem, which is it floods a little bit in the backyard.
Oh boy.
Because the water basically water levels, there's a water level that's higher than where the yard is. So I have to raise where the yard is above
the water,
another water source.
Take a lot of dirt.
And it takes a boatload of dirt. And so I've been calling pool companies nonstop.
Get any hits?
So most of them ignore me. And they're like, why? Like,
this guy wants free dirt.
You want free dirt? You can pay me for dirt. I'm not giving you free dirt. But one finally hit, and they're going to drop off a truckload of dirt at our house.
Good for you.
Yeah.
That's a good ecological, economical reuse.
I know. Well, the guy was like... Working with the guy has been impossible. I just want him to like make sure he can drop off all the dirt, and he's like, "I'm too busy. I'm just gonna send a truck, and like it works or it doesn't."
That's all right. Well,
so that's one of them, and then I have a rock wall now in the middle of the theoretical yard that I'm literally like, after work I go pick up some rocks, I put them in a wheelbarrow, and I bring them down.
Is that just there?
So it's probably like from the 1700s.
I know there's all these historical rock walls.
Yeah, that were just random and so forth.
Okay, so that's just there.
It was just there.
Yeah, you're just working on chipping away.
And I'm just like trying to move it.
Yep.
And then another fun one is we have ferns. So basically it's a forest and there's a bunch of ferns, right? And all the ferns have been overgrowing onto our like where we're going to put grass. But if I'm going to put dirt on top of the ferns, eventually what's going to happen is the ferns are going to grow through the grass, and I'm going to have an even bigger problem. So before all the dirt comes, I got to literally take a shovel, go underneath the roots.
All the roots out.
Wow, it's impossible. You got all these like the roots are so thick, but I'm trying. Right, and you gotta pull out each fern individually, but you can't just pull out like the little stem. You gotta like pull out the whole thing. It's like just like 5 by 5 thin of dirt, which is really just roots all together.
So I guess it's safe to say add gardening and landscaping costs to the cost of the home.
Well, yeah, our choice was either I did it, or they were people were going to charge us $100,000. So I can either pay $100,000 for a landscape, or I can go out there with a shovel.
Yeah, get some outdoor time, vitamin D.
Right, but that's the thing. Like all construction costs are wild.
Yeah.
Like
they'll send a crew, they'll get it done, but it costs you a ton.
Right, like I'm broke because I just bought a home. And now you want me to pay $100,000 for this? Like
not gonna
happen. Crazy. That we have more problems in this house. Since we're on the topic, we have ants.
Go through them
all. We have an ant infestation currently.
You get bit by those too?
My hand is all ant bites right now. I think while sleeping, I'm not really sure. It's pretty disgusting.
While sleeping?
I don't know. It's either when moving the rocks or like I don't know. But
okay,
we have a bunch of ants, so that's fun.
Yeah.
Well, actually, how we kill ants?
What, you got some?
No, there's like this dye that you put where you think ants are, and basically it's like this chemical that'll kill people, or not kill people. I think it kills the ants.
Hopefully
Basically,
not
the
people.
ants basically eat it. I hope it doesn't kill people. It's all over my house. I barely know where it is, which is probably a problem. We'll figure it
Just
out
the
later.
ants, just for the ants.
But basically, yeah, I'm not trying to kill anybody. Anyway, yeah. So like the ants will come and they'll eat it, but it doesn't kill the ant right away. The ant then brings the chemical to their home base, I guess, and they give it to the colony of ants, and all the colony eats it, and then eventually they all start to die because the worker ants are bringing poison back that I'm planting.
Pest control has gotten pretty advanced today, huh?
Pretty kind of
It's
cool.
chemical warfare against the ants.
It is, but oh no, well, I'm not. If you were to pay somebody to do this same work,
Like exterminator.
exactly, exterminator's going to
Oh, that's
cost
a good cost.
right. It's going to cost another what, $5,000, $2,000.
Spray your whole house
Right.
for a day.
Exactly, it all starts to add up on that. I have a basement that is beyond belief humid, but by the way, the whole point of this is there are so many costs and headaches with owning a home that you don't realize. When you're renting, you don't have to deal with this. You call your landlord, I have an ant problem. They have to go deal with this.
It is true.
And so forth.
Place is kept all nice.
Right.
Apartment.
You have no responsibilities. It's fantastic.
So definitely some things to consider.
Yeah.
Before you buy that home.
Oh yes, this humid basement.
Get some dehumidifiers down there. Another expense.
Yeah, so that's another expense. But what basically it stinks down there. And then what's also happened is like we got flies. It's more humid in my basement than it is outside. So now all the flies want to come into the home.
Make a new home.
And make a new home because it's more humid.
So you got to get a fly catcher now.
So almost, yeah. So we had over 30 flies. And we can see where they're all coming in. On our like store, it was just, I was so disgusted.
Is there a hole or something? A vent?
I don't know. They get in there. And so A
pro tip, telling you, take a cup,
yeah,
put a little bit of wine in it, and they'll all dive into it, get stuck, and that cup will be full of flies soon.
okay.
That's not going to stop the root of the problem, though.
Yeah, the dehumidify. And then like, I was actually walking today on the carpet and it was just like wet.
Oh.
I was like, this is actually disgusting.
Oh my God.
Because carpets, they capture the moisture.
Yeah.
So I think this carpet is capturing the moisture. And if I don't solve this humidity problem, then the next problem is I'm going to have mold somewhere in the wall.
That's
which is even worse. Yeah. Right? So
you don't already, right?
Not that we know of.
Okay.
That was another one. I removed mold in another part of the house. I almost killed myself with bleach. And then I got bit by a spider and like can barely wear shirts when working. So it's all. I love home buying. It's so much fun.
Journey.
Yeah, yeah, and so that is all the things you don't have to deal with renting.
All right, that's a good comparison between the two.
Yep. And so, any other questions about home buying over here?
I think you certainly just answered all my questions about what to expect when buying one. So I think I'm going to rent for now, but
take advantage of it. And then maybe you'll have a nice person will come into your life, and then you won't have a choice, and they'll just say, "I don't care about your math.
I'll do the math. I'll show it to her."
And they'll be like, "Nah, you're getting a home."
It's coming soon, I'm sure.
Basically, expect that it's way more expensive than the paper price, and that there are going to be problems no matter how good. Even the new homes nowadays are having major problems because what happened? The construction cost went up. And so they're building it cheap.
Yeah.
And all those new homes are like not good, essentially, and falling apart. So even the new homes aren't okay. The construction people have to make their fair share of money too.
Of course. A lot of things to watch out for.
Yeah, a lot of things to watch out for. I think more of the story is, yes, when we go back to this debate, yes, renting. If you're renting and investing your money, keyword, and investing, it can be smarter in today's market, and that renting isn't like this, you're throwing away money type of thing. It can be very valuable, and you can build wealth with it. At the same time, you can't build a family in a stock portfolio, unfortunately, unless you're marrying Apple, and I think that's a fruit. Is it a fruit?
It's a fruit and a company.
It's a fruit, but you can't marry. Well, I mean, you can't marry the Apple. It's gonna basically you can't do it. It's an inanimate object, either fruit or stock.
It's true.
Nvidia is also an inanimate
Don't
object.
get married to it.
So you can't get married to them, but you can raise houses. You can do that. So just make sure to compound that wealth, and we will wrap it up there. Oh, I also forgot, don't get bit by spiders. It really, really stinks. So we'll wrap it up there. Thank you, everybody, for joining us today, and we'll be back at it in 2 weeks. So let us know what you want us to talk about. Oh, follow us on Hedgeye Podcast, and we are Hedgeye NexGen in Hedgeye Podcast, all over Spotify and the Apple streaming service. And you can follow us on the Twitters, Hedgeye AI, and he is
HE Digital Assets.
HE Digital Assets. Thank you, everybody.